Most silver ETFs do not actually own silver in the way you think they do. PSLV is one of the few that does, and that single difference is why this fund exists. PSLV is the Sprott Physical Silver Trust. As of March 2026, it holds about $10.7 billion in assets, sitting on over 216 million ounces of physical silver. Every ounce is an LBMA Good Delivery bar, fully allocated, stored in a Royal Canadian Mint vault in Ottawa, and unencumbered. No leases, no lending, no derivatives. With silver trading around $80 an ounce, the appetite for physical exposure has exploded. Inflows into PSLV have run steady all year, and the trust now ranks among the largest silver-focused vehicles in the world. For investors worried that paper silver and physical silver may not be the same thing in a real crunch, PSLV is the answer. Here is how it works. PSLV is technically a closed-end trust, not an exchange-traded fund. When you buy a unit, you are buying a fractional claim on the actual silver bars in the vault. The trust does not lend the silver to bullion banks. It does not use it for futures collateral. It just sits there. And if you accumulate enough units, you have the legal right to redeem them for physical bars on a monthly basis, subject to a minimum delivery size. Now, here is the catch. Because PSLV is a closed-end trust, the unit price does not always match the value of the silver inside. PSLV often trades at a premium to its net asset value, sometimes meaningfully. When demand for physical silver spikes, units get bid up faster than the trust can issue new ones. That premium is real money you pay on top of the silver itself, and over time it can quietly eat into your returns. Why does that premium exist? Two reasons. First, retail demand for genuinely allocated physical silver has structurally outpaced supply. Second, PSLV gets a unique tax treatment that makes it attractive enough that some buyers willingly pay up. Because the trust is organized in Canada, the IRS classifies it as a passive foreign investment company. With a one-time election filed on Form 8621, your gains qualify for the standard long-term capital gains rate, around 15 to 20%, instead of the 28% collectibles rate that applies to SLV and most physical silver ETFs. That single tax election can be worth thousands of dollars in a strong silver year. On performance, PSLV closely tracks the spot price of silver minus a 0.45% annual expense ratio. That is actually a hair cheaper than SLV's expense ratio. The drag is small. The bigger swing factor is the premium you paid going in and the premium when you exit. Who is this fund for? Long-term silver bulls who want real, allocated, unlendable metal, who plan to hold for more than a year, and who are willing to file one extra tax form to get the capital gains rate. If you are a short-term trader or you do not want the PFIC paperwork, SLV is simpler. One honest caveat: watch the premium. Buying PSLV when it trades 5% above NAV means silver has to climb 5% before you break even. If this breakdown helped, drop a like and subscribe. In the comments, tell me the highest premium you have ever paid on PSLV and whether you felt it was worth it.